Joining us now, Citi U.S. equity strategist Scott Chronert. Scott, welcome. So things are really bad, but neither the economy nor the market will tank, you think. Why is that?
Well, we've been arguing earnings resilience for the better part of this year, and we think as we go ahead into 2024, you have a couple of things unfolding. First, the current setup for 23 is such that we think we're going to get a normal upside surprise pattern with Q3 results, which actually lifts what we think will be full year 23 estimates up to potentially a 225, maybe 230 level. What that does is give you a pretty decent base for heading into 24. There, our 245 estimate is probably higher than most consensus, but nevertheless, we feel very good about that as a function of some of the underlying sector dynamics at work.
So what are the wild cards, though? Are there things that you're watching? There's plenty going on in the world that you could be worried about, where if one of those or two of those or many get out of hand, then your opinion changes here?
Yeah, so I think there are obviously many components to this. Obviously, we're watching the Middle East situation. The interest rate backdrop is probably more front and center right now. The move up to a 5% 10-year certainly has a couple of implications. The first is valuation, which we're less concerned about. The second is more the manner in which it plays through to end demand. There, we're comfortable that a lot is being discounted already, and that ultimately, with some of the action we're seeing on the industrial side of the economy, there's actually some room for improvement from here that offsets some of that potentially high impact.
Scott, I'm looking at your note from Friday, I believe, and you say in it, in a nominal world where higher for longer inflation risk carries with it an implicit tailwind to most corporate fundamentals, even as margin issues remain an ongoing concern. A tailwind. Break that down for me.
Just if you think about it, us equity investors, when we're navigating the earnings situation for the S&P 500, we have to remember that we do live in a nominal world where our revenues and potentially our margins and earnings can be influenced by higher inflation. It enables you to price higher than you would otherwise. Now, clearly, we have to pay attention to margin risk and the influence that input costs can play. But in aggregate, what we're pointing to here is that, much like we saw for the better part of last year, is that, heck, as it turns out, higher inflation is good for revenues. It implies something about the ability to price and does come with it a positive benefit to S&P 500 earnings.
Okay. Does that, I mean, if you have higher, I'm just reading through on this. If you have higher inflation and thus a Fed staying higher for longer, is there a point at which that dynamic, that tailwind would turn into a headwind?
Yes, very clearly that's what we're watching for. And so the pivot points here become pretty important, right? So if you play it through, let's think about how the world might look 3-6 months from now. Let's say you do begin to get a slowing as a function of the Fed rate backdrop and the 10-year rate situation in addition. Well, as you get to that point, there might be an earnings read through to the negative, which we think is probably more contained than commonly perceived. But the flip side of that is that then you begin to talk about a different Fed circumstance. And quickly, what at that point you might lose in earnings, you gain in valuation support. Ultimately, it all kind of plays through, and you get to the other side of this concern regarding the interest rate backdrop that we think ends up setting up the S&P 500 pretty decently from an earnings picture.